Festive greetings to everybody, to all you Wealthify audience. Hope you're all well and staying warm in this difficult winter time. Start off by thanking everybody for all of our Wealthify customers for their continued engagement and custom throughout the year. We know it's been that the financial markets have not been kind to anybody in 2022, including impacts on your plans, on people's daily lives. And that's why we're doing these vlogs. We want to keep the communication methods going and keep talking as much as possible during these difficult market times, which is why I have Colleen and Kyle on the call for you today as well. Colleen is our CIO, as you may know from our last vlog, and Kyle is our deputy CIO. Hi, folks.
Hi, everyone.
Hi, Andy.
Between them, they have, I hope you don't mind me saying, guys, decades of experience, despite their youthful looks. And I brought them again together for your viewing and audio pleasure. So let's start with you, Kyle. Just give us a recap on what's happened in 2022 then.
Yes, 2022 being a very difficult year for most asset groups. I think, yeah, you've seen it in your plans. There really hasn't been anywhere to hide. So if we look at some of the wider gauges, the MSCI World, which is developed market equities, down nearly 20%. The story is a little bit better in sterling terms, and that's due to the stronger dollar and obviously the strong US exposure in that index. So I think that highlights one of the areas where it's only been the place to hide is in US dollar cash. It's been a haven trade. There's been a flight to risk, a risk-off sentiment. And you can see this even in bonds. I mean, bonds have been battered this year as interest rates have risen sharply. And we've seen correspondingly yields have lifted off spectacularly. So the FTSE World Government Bond Index also down nearly 20% in local currency terms. So a very difficult year all around, lots of volatility. We've seen a pattern this year, sort of a general downtrend, and then littered with periods of market rallies, what we call bear market rallies. The most recent one being sort of over October, November. Yes, I think that's essentially been the pattern, but certainly a downward trend in 2022.
Cool, thank you, Kyle. Lots of really good detail there for people who are fascinated and interested in the investments market. Colleen, can you give me a one-sentence summary of what Kyle's just said for those who are less aware of some of the detail and some of the terminology that Kyle's just gone through? What's happened in 2022 in one sentence?
One sentence, it's been an awful market, except if you held dollars. Cool.
And Kyle mentioned bear market rallies. What's a bear market rally?
Yeah, it's a good question because we've heard the term used a lot year to date. Basically, it's a situation that occurs when the market is tracking downwards, and you have this period of interruption in the downward trajectory where you have a burst of optimism and you have very, very strong market rallies. And we've seen that a lot this year. In fact, just taking the S&P 500 as an example, we've had 7 bear market rallies this year, averaging, gains over 8%. And in fact, during the summer, in July, August, we had one particular bear market rally that saw a gain of 17%. So basically, any quick summary, it's sort of when you see the market rally up, but it tacks back down again and it ends up lower than where it started from. It really speaks to why you shouldn't time the market. It's so difficult to do. And I know you're sick of us saying it, but it really is a case of, staying invested for the longer term and, yeah, being in the market rather than timing.
Cool, thank you, Colleen. So staying in the market kind of makes us look a little bit forward into 2023. Kyle, what's some of the key economic considerations that's kind of they're going to keep you awake at night during 2023, do you think?
Well, everything's about inflation in developed markets, particularly in the US, those sort of wider inflation numbers, as well as some of the core numbers. So, if we focus on the inflation number, just taking it a few levels back, the real concern is in the labor markets. So essentially, unemployment is at sort of record lows. Obviously very tight in the labor market, which is, driving those wages higher. And I think the central banks are really laser focused on quelling that impact, because that can cause a long lasting effect on inflation. So essentially that's driving up interest rates, which is in turn driving down growth expectations and in turn your asset prices, so your shares and your bonds. So the biggest thing I would say is inflation driven by very strong labor markets. That's where our focus is.
Cool, thank you. And Colleen, what could that mean for us in Wealthify and our customers?
Yeah, well, listen, we do expect markets to remain volatile just for those very reasons that Kyle has flagged, notably inflation and interest rate concerns, and amidst this sort of weaker economic growth expectations. But what I would say is that markets do tend to lead economic turns by roughly sort of three to 9 months. And that's because markets are forward-looking. So with this in mind, we are hoping, or we certainly anticipate, a more sort of constructive environment for equities sort of towards the later part of next year. And we do want to be positioned accordingly for when those markets turn. I mean, I have to say, I'm sort of cautiously optimistic for next year. Despite the sell-off that Kyle has spoken about this year, it does mean that as a result of that, valuations are now lower. And if valuations are lower now or today, that might or should mean sort of future returns. The expectations should be better over the longer term. So in terms of portfolio, Andy, we're sort of a little bit more cautious on the near term. But as we sort of push out into 2023, we do anticipate a lot of the sort of headwinds that we've experienced to sort of turn into more tailwinds.
Cool. And how are we currently positioned? We bucket our investments up into kind of 20 percentile. So the amount of equity we have in our portfolios can be 0 to 20, 20 to 40, 40 to 60. In that kind of 0 to 20 factor, and that 0 to 20 scale, where are we currently positioned?
Yeah, so we're at the sort of outer realms of sort of risk off at the moment, meaning that, if we take our more aggressive plan, which can have up to 100% weighting towards equities, we're now sitting at an 80% equity weighting. So, you would certainly construe that as being a little bit cautious. Yeah. And we're cautious for all those reasons that Kyle said. But we do very much anticipate the opportunity to get back into the market and get closer to that 90%-ish. Because at the end of the day, in terms of growth potential, the growth potential over the longer term is certainly equities as opposed to bonds or cash.
Yeah, so 0 out of 20 on our risk preference currently, because we're keeping, because of the continued volatility, but we're keeping our powder dry, ready for when we see the market turns.
Yeah,
cool.
That's a fair summary.
Correct.
Cool. So a couple of last questions then, Kyle. I'm wearing this hat clearly for a reason, not just to keep my my head warm. If Santa could gift something investment related, some kind of investment market related gift for you for next year, what would it be? What would you be wishing for, mate?
Well, I'm going to go big on this one. I think at a wider level, and while it might be more sort of a geopolitical issue, the end to the war in Ukraine would be sort of top of my wish list. I mean, besides the market impact, I mean, we're all aware of the truly horrific humanitarian impact it's had and the disruption it's caused. So I think the downstream impact on markets across the board, commodities and inflation, the disruption to lives sort of across the world, just to see an end to that would really be such a relief.
Too right. Amen to that. Colleen, similar question. What's your investment related New Year's resolution going into 2023?
Well, my wish for clients and plans is to see the sort of multi-asset class portfolio, that portfolio that's got a mixture of stocks and bonds. People call it the classic 60-40 portfolio. I'd really like to see that come back into vogue. I'd like to see bonds resume their role of providing a hedge to portfolios in terms of performing in periods of economic distress. It's been a really, really weird year for bonds this year, and I'd like to see them revert to let's bring bonds back in vogue and business as usual from that perspective. So it's a risk management request, Andy.
Cool. Well, hopefully Santa's bag and sack will be big enough to grant you both your wishes, alongside all the good work that you guys will be doing in managing everybody's investment portfolios. I know as a business we're going to be delivering some really exciting proposition developments as we go into the new year. So really looking forward to talking to all of our customers about that as we go into 2023. But for now, it's goodbye and a Merry Christmas and happy festive period from us three and from everybody at Wealthify. Merry Christmas. Hope you have a lovely time and keep safe and stay warm. Thank you, everybody. Bye.
Merry Christmas. Bye.